Hey everyone, welcome back to Corporate Decoder, where we uncover the hidden stories in company filings. And let's just say Moatable's latest report has a few surprises up its sleeve, especially when it comes to their cash situation. Alright, company sniffers, let's dive into Moatable's performance report for the period ending June 30, 2025. First up, let's peek at their balance sheet. As of June 30, 2025, Moatable had total assets worth around $59 million. Now, for the really juicy bit, their cash and cash equivalents took a nosedive. They went from about $27 million at the end of 2024 down to just over $17 million by the middle of 2025. That's a drop of almost $10 million in just 6 months. Talk about a cash burn. On the other side of the coin, their current liabilities stayed pretty steady around $23.5 million. So their cash position shrinking while their short-term obligations remain stable isn't exactly a recipe for comfort. Now let's look at how they actually made their money or, well, lost it. For the 3 months ending June 30, 2025, revenues jumped up to $19.3 million in the same period last year. That's a nice 26% increase. And guess what? They actually turned a profit in the 3 months ending June 2025, making about $507,000 compared to a loss of $472,000 the previous year. That's a huge turnaround. But hang on a second, if we look at the 6-month period, their operating loss actually got worse. It went from a loss of $222 million in the first half of 2024 down to a smaller loss of $525. This is a bit confusing there, showing improving operating income for the quarter, but a worsening loss for the 6-month period. Digging deeper into the expenses, we see here that share-based compensation expense went down significantly. For the 3-month period, it dropped from $1.3 million to just $374,000. This often happens when stock options and awards granted in earlier years fully vest. They also had a big improvement in their impairment charges, going from $2,000 in the first half of 2024 to zero in the first half of 2025. That's good news, but also makes you wonder what intangible assets they were writing down before. Now, about that acquisition in May 2025, they bought Truckers Best Insurance LLC for a total of $2.8 million just to get into the insurance brokerage business. They paid $1 million in cash, and the rest was contingent based on future targets. And with that acquisition, they booked $2.1 million in goodwill. This goodwill represents things like expected synergies and assembled workforces. It's basically the premium they paid over and above the identifiable assets. Looking at the equity statements, we can see a special dividend of about $11 million was paid out in March 2025. This explains some of that cash drain we saw earlier. In stock options and restricted shares, they have a lot happening. It seems a significant portion of those stock options granted in earlier years are now vesting and being exercised. For example, the unvested restricted shares had a significant drop in total unrecognized compensation expense. The company highlights a decrease in selling and marketing expenses due to a change in how they account for sales tax. It seems they are now charging sales tax to customers, which is a good sign of operational maturity. Overall, operating expenses went up slightly. But let's look at the individual components again. Research and development expenses increased quite a bit by 32% for the quarter. This is likely for developing new features and products for their SaaS businesses, which is important for future growth. Now back to that cash flow. For the first 6 months of 2025, they used $2.8 million in cash from operations. Remember, they were profitable in the 3-month period, but the 6-month period shows a different story, and that's mainly due to those changes we talked about in accounts receivable and other liabilities. On the investing side, they moved from using cash to generating it. They redeemed $5 million in short-term investments, which also helped boost their total cash. Financing activities show a big outflow of $11.2 million in the 6-month period, primarily due to that special dividend payment. And here's something that always catches my eye. They admit their disclosure controls and procedures are not effective. The report specifically calls out material weaknesses in their systems for risk assessment and sales tax compliance. This means they might have missed something important in their financial reporting. This particular weakness is quite significant as it directly led to an understatement of their sales tax liability. While they say the impact wasn't material to previous financial statements, it does raise concerns about their internal controls and financial reporting accuracy. Looking at the big picture, Moatable is clearly shifting gears. They are leaning heavily into their SaaS businesses, Lofty and Trucker Path aiming for growth through subscriptions and advertising. The recent acquisition of an insurance brokerage business, as mentioned here under acquisition, is an interesting diversification move, but it's always a risk when a company enters a new industry. Internally, they're trying to strengthen their financial reporting, which is a good sign, but the fact that they still have material weaknesses means they are walking a tightrope. Alright, that's our breakdown of Moatable's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think that acquisition will pay off, or is the shrinking cash and reporting weaknesses too much of a risk? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more in-depth discussions, and I'll see you in the next video.